it's better if the founder's prepared to try to answer the most common questions. And that's kind of what we see as snag. Like, we'll ask for something and we just never can get comfortable with the market size. Or we never get comfortable with like a financial plan, and we don't believe the founder has any idea where they're going to be a year or two from now, or how they're going to get there, how many people they have to hire. Like, we want to see a basic understanding of how they're going to run the business. What are they going to do with the money once we, invest? So I think it's really important to be ready before you go have the first investor meeting. You really want to have all the documents kind of in line so that you can get all the way through the term sheet and then, into diligence, and not start making things as you go, because that's going to make for a lot of very long nights and a lot of delays. And delays ultimately kill investment opportunities because we start losing faith in the founders, and that's the most important part of the process.
Mark, thank you for joining. Really excited to chat with you today about Las Olas's investment process, so we can learn a little bit more about how y'all make decisions and help our founders get smarter around the fundraising process overall. Appreciate you taking the time.
Yeah, thanks for having me. I'm looking forward to this.
This is Air CFO's Funded series, a show where we pull back the curtain on venture capital fundraising from both sides of the table. I am Alex from Air CFO, and we are on a mission to demystify the fundraising process for founders everywhere. And today, to that end, we have Mark Volchek, the founding partner of Las Olas. Mark is founding and co-managing partner at Las Olas VC. Prior to LOVC, he spent 15 years as the CFO chairman and then CEO of Hire One, company co-founded in college in 2000 that ended up IPOing in 2010. And when Mark left Hire One in 2014, their products and services supported more than 1,900 schools and approximately 13 million students across the country. Mark currently serves as on the executive committee of the Florida Venture Forum as their program chair, and is also vice chair for the Fort Lauderdale Aviation Advisory Board. And he's previously served as the director of the Founder Institute in South Florida, as well as having angel invested in over 30 companies over the last decade or so. Mark, really excited to get some insights from you about your journey to VC and how you evaluate companies at Las Olas. Love to start things off by hearing in your own words the mission and the thesis of Las Olas, and maybe, if applicable, when you are meeting a founder for the first time, how would you describe what makes Las Olas unique within the venture capital space?
Sure. Thanks for that intro, and excited to tell you more about Las Olas VC. We really see our mission as supporting great founders, helping them build great businesses. And we support founders as more than just the capital. We really believe that we're sort of, value-add advisor. We often join the board of the companies we invest in. But primarily, we're there really to support the founder, the management team, and enable them to really build a great business, with that capital and that advice. So more specifically, we're looking to invest in B2B software companies at the early stage, usually seed. We sometimes do pre-seed or Series A, but generally in that early stage where the company is just discovered or just proven product market fit. So that's usually, paying customers, live product. It doesn't have, not perfect, but we do want to see, evidence that there's a need for the product, that customers like it and use it. And that's kind of where we try to invest and deploy our capital. What makes us unique is that, Dean and I started the firm both as operators. So we spent, as you just said, 15 years building Hire One. Dean had a career in sort of corporate America at the beginning when he got started, and then did some private equity backed companies before joining my company in 2002. Hire One was a fintech company. And so we built that together. And so having that perspective of being an operator really helps. And so when we meet founders, that allows us not only to evaluate sort of the business proposition, evaluate the management team and everything that goes into sort of deciding what to invest in, but we think it also allows us to be more helpful advisors and more practical sort of, sounding board than someone who's never been in that seat. So I think that's a really important piece as we think about, the value we add to a seed stage, company.
How do you think yours and Dean's background as operators impacts the types of companies that you fund or what you look for when you're evaluating founders as opposed to an investor who might have spent the majority of their career on the capital allocation side.
So, we clearly spend a lot less time studying financials and maybe doing models. I think that's a misguided approach for early stage investing anyway, because the models are only, as good as the input. So we do review that and we really think about sort of financial modeling and projections as sort of an output of, the thought process the founder puts into it, their vision, where do they want the company to go. But we mostly focus on sort of the market demand. Is there really customer need? Is it solving a real problem? And then we focus on the management team. So the founder, the folks they brought on, are they the right people, the right team to solve this problem? Do they have some asymmetrical knowledge? Do they have a good founder sort of, problem fit? So we really focus on the people. And I think you can only do that when you're an operator. We've interviewed, thousands of people. We have, almost 1,000 employees at R1. And so in some ways, investing in a founder or a management team is very much like hiring folks at a company. It's evaluating, can the team, pull off what they say they're going to do? Because every plan we get, or most plans we get, show a home run. And the question is, who can actually hit that home run and who can actually achieve and do what they say they're going to do. And that's really the biggest thing for us. It's about the team and then also the feasibility. Like, look at their sales plan or look at their lead gen plan and then compare it with their hiring plan. So if they're going to add, 5 million of sales and only have one salesperson, that might not be very realistic. And so we look for those types of things to try to evaluate the team in terms of what they've accomplished and what we think they can accomplish going forward.
Yeah, it sounds like you place a pretty heavy emphasis on execution, which model can help you evaluate just as a bit of a sense check. Like, does this founder have a clear-eyed view of what it's actually going to take to build a thriving business? Because I think, yeah, it's pretty easy to spot the red flags when you are looking at a financial model and you see 5x year over year growth with only adding a handful of salespeople or something along those lines, unless they have a really, really strong story to justify why they think that that is feasible.
Right, exactly.
You mentioned market demand being one of the biggest criteria that you evaluate when you're looking at potential investments. As you know, at the early stages, a company is not going to have a ton of data points that actually could potentially show the total size of the market demand. How do you think about, like, what are the key indicators of market demand that you look for a pre-seed or seed stage startup?
Yeah, so I think there's two pieces to that. So one is obviously trying to size the market. How big is the market? Is it big enough to create a venture scale business, which for us generally is at least $1 billion market opportunity, ideally 2 or 3 billion or more. And then the second piece is really evaluating, like, does the problem really exist? And is it a big enough problem that customers or potential customers are willing to pay for it? And that's where we first, try to talk to some of the customers the company already has. But then we also try to do market checks and try to connect with potential customers and see if they think this is a real problem and what their willingness, to become a paying customer is. Often we'll make some intros for sales, and see how those go, right? So it's, we'll do some lead gen and sort of follow that. We'll look at the sales pipeline. Sometimes we'll listen to recorded sales conversations. So many other companies record sales calls. And so we do some of that diligence. But some of it is sort of, an early stage company comes down to sort of a small amount of data and trying to extrapolate that to a much bigger outcome. And we're not always right. We just try to be right more often than not. So, but, we also rely on the founder's expertise. So we look for founders who have some, sector expertise or market expertise that, we don't have. And we try to validate that as well by checking references and by, spending time with the founders and learning about their backgrounds and their knowledgeable.
Yeah, that makes sense. I mean, you can do as many market sizing analyses as you want to, but at the pre-seed seed stage, I don't know if anyone really has a clear sense of what the overall market is for a product that's still in its infancy. And a lot of what it feels like early stage investors are betting on is the ability of the founding team to be able to grow the size of the market over time or readjust their positioning to go after a bigger market. So it's a bit of a moving target. I think, yeah, from the conversations that I've been having, it feels like it all traces back to the strength of the founding team and their ability to figure things out as you go at the end of the day. So I'd love to take kind of a macro level view of your investment process from first engagement with a founder all the way through to term sheet. Before we dive into the individual components, just to give us a sense for what your pipeline looks like, could you give us in broad strokes sense of like the number of opportunities that you evaluate even before you get to the first meeting, and then how many of those pitches end up making it to the first meeting, and how you move companies through each stage of your investment cycle?
Yeah, so we look at, thousands of opportunities every year, some years as many as 3 or 4,000 to ultimately only make 3 or 4 investments. So, we look at a lot of opportunities, but I would say, only about 10% of those really make it to a first meeting slash, Zoom call. And a lot of them just get screened out based on their deck. We only invest in B2B software, for example. So if we get consumer things or hardware or deep tech, we generally screen those out. And that's like one advice, to throw in right here is to give founders is to really do some research on folks rather than sending out emails to thousands of investors. Really find the, 100 investors that invest in what your company does and make them much more targeted. That's much more useful. So, really to get all those inbounds, either cold or intros, or I meet people at events. And, so the pipeline comes from many, many different places. Ultimately, we take a few hundred, actual meetings. Many of those meetings will be, our senior associate or principal or, somebody on our team. And, what I would say is it's fine to build a relationship, with those folks. And I often hear from founders, they only want to talk to a partner. But the reality is I only take a few first calls a year. Most of my time is spent with existing portfolio companies and on second calls and later stage, diligence. So the key is to build maybe mid-level or junior person at the firm to have them become your advocate, because the way you get to the next step is that they present at our sort of weekly meeting and get one of the partners to be interested to take, the second call. And that's really an important stage. And at that point, that's the time to build that relationship with a partner and then, make sure that now you have a team, working, with you and advocating for you. And so that's really our second step is to meet to pitch one of the partners. Then we do some more work. Between each of the meetings, we do work. We also will send questions. We'll do some diligence. We'll review the model. And after the second meeting, we might send a whole diligence request list. We continue to work through getting comfortable. And then for us, the third step is really to meet the entire team. So that's generally 3 partners and as many of the other team members as possible. To then make a final decision ultimately within a few weeks. We really try to keep the process fairly streamlined. So from a first, meeting to a potential term sheet shouldn't take more than 3 or 4 weeks. Once it starts taking longer and longer, usually there's some hang up or there's something. We try to give folks a quick no. If we're not going to get there, we're looking for, a reason as soon as possible to say no, rather than spend 3 weeks and then say no at the end. We really try to identify the issues or something that disqualifies the opportunity for us as quickly as possible. But if we don't, then, we go through the process and we, would like to get the term sheet within that 3-4 week time frame. And that's really for us the start of like confirmatory diligence. We'll dive in deeper, we'll spend time. But for us, we close on about 90% of term sheets that we issue, or I guess that gets signed. So very high close rate. But there are situations where we discover that some of the things that we thought were true aren't true. And, you find inconsistencies. And that's really what often kills investment opportunities, post term sheet, but that's very rare, at least for us.
That's really helpful. Um, so you mentioned, let's just say for round numbers, maybe you have 2,000 opportunities that you evaluate a year, and 200 of those, 10%, make it to the first call. How should founders be approaching their initial calls with your associates to arm them with the knowledge and conviction that they need to take into your weekly meeting to move them forward in the process?
Yes, I would say, the first step, even to get to the first call is really make sure that the investment opportunity matches the criteria we're looking for, right? So that the founder can point out why they meet all our criteria, the better, really early on. And then, in that first meeting, it's really identifying, why the team is the right team to do this. What's the secret sauce? It's really the major things, why the market is big enough, all the things that I just mentioned that we look for is convincing, the person they're talking to is that it meets all those criteria. But at the same time, we're also evaluating the founder of the team. So it's important to, be on time for your meeting, be professional, make sure you go through the deck. We see many founders, they say, well, I'm not going to pitch the whole deck. I'll just give you an overview. That's not a great strategy because a deck is a good visual reference that people can remember. So all those things are important. The other thing I would say is follow-up is really important. So if there's follow-up during the first meeting, make sure you send that promptly right after the meeting. If, there's a copy of some materials that, were presented during the meeting. This time, again, is nobody's friend. So the faster the process goes, the better generally, because the best founders are well prepared. They have the materials ready. The last thing we want to do is ask for, market sizing and surprise the founder that it takes a week to get a document. That's not great because now you may have missed the next weekly meeting. Now it may not get presented till 2 weeks later, and then nobody remembers that first meeting anymore. You got to, founders, I'm sure know that we have Zoom calls all day. We're all booked on sort of back-to-back meetings. So the more time that goes by, the less anybody remembers what happened a week or two ago. So it's important to keep that pace up and really move. And we often move our process as fast as the founders do. So if we ask for something, we get it back, we look at it, we have a formal meeting once a week, but we have other check-ins. So the faster the founder moves, the faster we will move. And I think that's for us an important criteria because building a business is all about urgency and getting customers to do things and building your business quickly. We want you to get the 5 or 10 million revenue in a few years, not in 10 years. There's a big difference between, doubling every year or doubling every 5 years. So it's important, like speed is really important. And so we've seen founders that have built great businesses, but they're just too slow. They've built a, $5 million business, but it took 10 years. And by that point, it's not a venture scale business anymore.
I really appreciate the attention that you seem to place on some of the like micro level details of the interaction that you have with founders. And I think that is really smart because when you are investing in a founder, you're investing in a 5 to 10 year long relationship. And so it's a high stakes commitment that you're making, or it's just a commitment that is going to span a long period of time. And so you really want to take every data point that you can get from the handful of interactions that you're able to have with them. I mean, because you need to move fast as an investor in today's environment. One line that's come up quite a few times in the conversations that I've had through this series is like, how you do one thing is how you do everything. And so I think it will benefit founders immensely to show that they are prepared and that they are able to move quickly and that they just have a really strong grasp on the process, to instill that confidence with investors through every interaction that they have as they're going through the pitch cycle.
Yeah, I agree. And it's really important to remember that everything you do from the first interaction, the first time you reach out till, exit your company, maybe 10 years later, everything is part of the evaluation process. And obviously once we invest, we're on your team. But everything we do then together is evaluated by the next investor or by customers or by potential acquirers, 5 years down the road. So it's really important to remember that everything is, part of the process. How fast you respond, how thoughtful, the format, timeliness, all kinds of
So
things.
when you move a company to the second stage of your investment process and you, Mark, are taking a look at the materials for a startup in preparation for a pitch meeting, and you open up the slide deck, what would you say is the first slide that you look at, or what's the one that you spend the most time evaluating?
Yeah, I mean, I would say it's really the entirety. Like at first, I just want to understand what the business is, but I need to understand that quickly. So you don't want to use 10 slides to explain the problem. It really needs to be like one slide, what's the problem? One slide, the solution, and then jump right into, maybe the business model, maybe the, TAM, maybe, the current traction. Like too often, like I don't see like anything about traction in the deck. Like, what's your current revenue? How many customers do you have? What do how do what are your KPIs? How much do you charge your customers? Like basic things. Because we have a preference for larger ACVs. We have a preference for problems that are really, or solutions that are painkillers, not just vitamins, as we call it. So problems that really need to be solved where the customers don't have an option, like they have to do something. And then this is the solution they can pick. But we don't like, solutions that customers don't have to buy because when things get tight or there's uncertainty, customers end up not buying anything versus if this a solution they need. So we look for some of that, but then it's, really checking off, TAM, ACV, traction, how much are you raising? Like the basic data is really important for us because that's how we screen out over 90% of opportunities we look at. So that's really step one. And then in step two, we really look for like, what's the secret sauce here? So if I've seen 10 similar businesses in the last month, I really want to understand like, why is this different? So I think that's really what's important is rather than spend 10 slides on here's all the problems in the world, is really lay out, here's the problem, here's the solution, here's why our solution is special. And then all the other, things we look for would really be helpful. And the thing to remember is for us, we only need one reason to say no. We're not looking for balancing, things. If the TAM is 300 million, we're going to say no. We're not even going to take a first meeting. If the traction is zero, we're not going to, it's just too early for us, right? So we're just looking for one reason that it doesn't meet our criteria and then we're done. So that's really the key for us is to try to do that quickly and efficiently.
Yeah, there are a lot of things that there are a lot of stars that need to align for a founder and investor to come together in a partnership that is going to be productive and successful over the period of 5 to 10 years. So that's one of the things that has become clear through conversations with a bunch of different investors is like, well, number one, all investors are evaluating companies slightly differently, and they all have slightly different views of the world, which is why it's so important for founders to have many conversations with investors to be able to find those true believers so that they're not trying to square peg in a round hole. And they're able to find the small subset of investors who really align with them on the dozens of criteria that need to be aligned on in order to make us for a successful partnership.
Yeah, and I think, it's really important because generally investors aren't going to change their approach. Often I have entrepreneurs telling me, well, we do hardware, but hardware is great and we're going to make so much money. But if our thesis is B2B software, we're not going to change that just because we see a great hardware company. It's just not something we focus on. We don't have expertise in it. So that's why the key is really to find and pitch the right investors because you're not going to be able to change sort of folks, investment thesis because we raise money from our investors and that's what we pitch them. And so we generally stick pretty close to what, our sort of bullseye is in terms of the perfect opportunity.
It's a really key insight that you just shared there that I think founders would benefit very much from knowing is you as the general partner are raising capital from your LPs based on a story that you're telling to them. And so it's also just good. It's part of being a good investor is remaining disciplined about your investment thesis. But additionally, you really need to stick to that thesis because that's what you have kind of agreed on with the folks who are giving you money to then go and allocate into the startups that align against that thesis that was in your pitch deck.
Exactly. Yep. That's really important to understand.
So when you talk about the secret sauce that a company can talk about when they are pitching, especially in a crowded, competitive landscape, what would you say is the single biggest trait that you look for, maybe specifically with the team, that is the highest positive predictor of future success in an early stage startup?
So I think it's really about some unique insights, unique backgrounds, some founders that maybe come from the industry, have discovered unique issues or problems, have a different approach to the solution. But that said, we generally don't like overcrowded, like very large opportunity spaces that have lots and lots of competitors. I think those are really difficult and require lots of capital to win in. So we generally tend to prefer opportunities where there's less competition, maybe an underserved market that's still large enough, several $billion of TAM, but has less sort of competitive pressures and less obvious problems. So really, we look for industry insiders that are solving a problem that's not obvious to maybe you and I, but is a big enough opportunity to make it interesting, not just for us, but also for the next round investor, maybe the next round, because every, later stage investors still have a return threshold and their exit threshold is much higher. And so they need a much bigger TAM to, get to their expectations. So that's really why we look for a few $1 billion TAM, but we don't love the $100 billion TAMs because being everything for everybody is very, very difficult and very, very expensive. So that's kind of how we think about, that unique insight, maybe first mover advantage, maybe some proprietary tech, even though that's usually, you know, less relevant in what we invest in.
Really makes a lot of sense to be prioritizing opportunities that might be overlooked by the broader market. I'm curious how you think about fitting that framework into today's environment when it feels like the entire industry has kind of piled on to AI companies as like the next big thing. Are there specific subsets of the AI market that you think make better investment opportunities for Las Olas? Like specific areas that may be relatively overlooked by the rest of the VC ecosystem? Or are you staying away from companies that put themselves out there as AI companies in favor of potentially like other types of businesses that might benefit from AI, but might be pitching themselves in a slightly different way?
Yeah, so I would say, I would put AI businesses in sort of two different buckets, or maybe even three buckets, right? It's sort of, the first stage is just using AI to make your business more efficient for customer service, for, FAQs. So that's really stage one. Then I would say there's sort of the next flavor of AI companies that use AI to make their product more efficient. So it's actually delivering AI inside their product. And then the third category would be sort of deep tech AI. So folks creating their own models, bringing some proprietary tech to AI, some deep research. And I would say what we're most interested in is the middle category. So it's companies that have a unique insight in an industry that then use AI and modern tools to solve the problem more efficiently than it's ever been done before. So, back in the day when I started my company 25 years ago, we were replacing literally paper with, first generation, maybe web-based software, right, in the early 2000s. And then, maybe 10 or 15 years ago, people were starting to be mobile first and replacing desktop applications with mobile. And I think today, people are bringing AI driven mobile solutions to industries that will never do it on their own, right? They need a custom solution with very specific guardrails. They need a certain model, certain data. That's kind of what we're attracted to is, I think about AI as sort of just another step in making solutions more efficient than they've ever been. and maybe exponentially so. I mean, AI is a transformational technology, but so was, in some ways, web and mobile. And, Excel was transformational when it was released, not sure how many years ago, but a long time ago versus, paper, right? Or, other computational resources. So that's how I really think about that. There's clearly a big opportunity in sort of the deep tech AI world, but again, that's a very expensive area. It requires much more capital than we can do as a relatively small fund. And so we're really looking for those companies that apply AI and modern tools to maybe antiquated industries that aren't using those cutting edge technologies today.
That makes a lot of sense, and it squares well with what you talked about previously with um, backing founders who have some hard-earned insights about a specific industry or problem set that a group of customers might be facing. So it sounds like the vertical AI space is mainly what you're looking at, like companies building AI into workflows to transform the way that work has gotten done in industries that haven't been impacted by the AI or the technology of the last like 5 to 10 years.
Exactly.
Are there any examples that you could share of companies that you've invested in that space, or just maybe specific types of opportunities that you're most excited about?
I'll give you two examples. One is a company that basically brings mobile, at first they were bringing mobile solutions to school buses. So they started bringing tablets that could do real-time routing, real-time student tracking. It has a parent app so you can track, where your, child is. And now they're adding AI to that to make it even more efficient to create routes, to make sort of smarter routes. If a bus if one of the bus drivers doesn't come in the morning, you can reallocate those stops to other bus drivers. So all that used to be done manually, literally on paper. You would call the driver, wait till they come back, and then send them back out to pick up the 5 kids who weren't picked up. So it's very inefficient. And now you can do that using AI and mobile technology in real time so that everybody can get to school on time. So that's a real world problem. Seems like somewhat of a niche business, but it's a $500,000 school buses in this country that operate still on mostly antiquated, software. And so that's one example in our Fund 2 portfolio. Another one that's using AI, that's probably more in the deep tech aspect, or kind of on the border between vertical SaaS and deep tech, is a company that essentially uses computer vision to sort of supplement quality assurance for plastics and car parts manufacturing. So they basically can real time identify, quality issues and alert the operator in the factory that they might need to redo something or take that piece out of the production line before it goes all the way through and it's too late to find that quality issue. I mean, they're using essentially computer vision with real time computation and real time alerts. And again, in a very specific industry that's actually much bigger than you would imagine, plastics, car parts, there's a huge amounts of dollars flow through those industries. Today more than ever, we're trying to make things more efficient. And particularly as we, see more manufacturing in the US, we think actually bringing AI and automation to manufacturing is going to be a very important theme in the coming years as more manufacturing comes back to the US.
Yeah, that's really cool. And those are both examples, I think, of businesses that are solving a very specific problem, but that could have wider applications once they nail the solution for their initial target market. So you can see like the TAM kind of expanding as they solve what QA, starting with car parts, but obviously manufacturing as a whole is a massive market. So yeah, I think that's it's a good way to think about like how can AI solve problems for real companies today and then expand over time to like build those $1 billion+ businesses that you're looking for. Love to talk a little bit about the VC ecosystem as a whole. Be curious to hear your take on it. Are there any aspects of the venture capital model that you believe are broken or just suboptimal as it stands today? Maybe based on the way the industry has shifted in the decade plus that you've been investing, and yeah, just love to hear your thoughts on where you think there may be opportunities to improve the way that the VC ecosystem works.
Yes, I mean, I think everything goes through cycles and waves, and the VC industry is not immune from sort of boom and bust. Many of the VC firms that were active in 2020 and 2021 are no longer around. There's some, industry reports that say half of them have made no investment since and probably don't even have an active fund. And I think that really is what, you know, is the reflection on what models work and what doesn't, right? Just like any business, the VC cycle is a lot longer because once you have a VC fund, you're kind of in business for 10 years. But if you don't produce returns, then investors won't invest in your next fund, and eventually the funds go away. And so I do think historically, venture funds, particularly in Silicon Valley, are focused on that one breakout winner and have lots and lots of zeros in their portfolios. And I think that's changing a little bit. We believe that, it's not necessarily sort of venture investing doesn't have to be unicorn hunting. I think there's many different strategies to have successful fund, and that's where portfolio construction is really important. And we think more about how can we have more winners and less zeros necessarily, and still have opportunities for breakout opportunities. But we're not counting on having sort of one unicorn and everybody else go to zero, because that's just not a great outcome. That's difficult to replicate. Feels like you need to get lucky. Plus, most of your founders end up unhappy, right? Because their businesses didn't work out. So we really try to focus more on businesses that have a high likelihood of getting to maybe 5 or 10 million revenue with an opportunity of getting to hundreds of millions of revenue and a huge valuation. But at least if you can get to some scale and you can get to profitability and then eventually have an exit, even though it may not be a 100x exit, it still creates a good outcome, and we can make some money back for our investors on that. But I think that's a little bit of a different approach. We really try to be more founder friendly and really focus on how do we make more winners in the ecosystem rather than focus on the few huge companies. And we think that creates good returns. We've created good returns in Fund 1 and 2, and we're kind of on track. And so I think there's many models that work in the industry, and the key is just to optimize the model that you've picked. But in the end, returns, speak for themselves, and that's what really creates long-term efficiencies. But I think some models that worked 20, 30 years ago may not be the models that work for the next 20, 30 years. It evolves. And I think the sort of cost of entry of starting a startup is very different today than it was 30 years ago. In the 90s, it was very expensive to buy servers and have a server room, and, very, very different world. Coding was much more labor intensive. Today, with all the tools and the web-based technologies and hosting, the barrier to entry is much lower. There's also a lot more competition because of that. And so I think the dynamics of the whole tech industry changes, and that requires adjusting the investment focus and the investment model to go with it. But I do think in general, we're seeing more focus in the industry on having more sort of winners, and less sort of need for those huge, outliers, because those are harder and harder to attain.
Absolutely. I've noticed that shift as well from conversations with VCs, that the previous model of, hey, we're going to have some big winners and 60% of our companies are going to go to zero. That might maximize a VC fund's returns if you're looking at it on a spreadsheet. But if you think about the ecosystem as a whole, that might not be like the most optimal outcome for a portfolio. And to your point, there's still fun performance to be had with taking an approach that is more focused on how can we like maximize the number of winners that we have within the set of investments that we make. And I think that's a good thing for the industry overall, because it leads to just more successful, sustainable companies. I think it's, to your point, capital requirements have never been lower to build a sustainable size business based on the tools that are available today with cloud compute and all of these AI tools that give people additional leverage. So yeah, that's a trend that I'm all for when it comes to the VC space. What's a misconception that you typically see startup founders holding about VC fundraising through conversations that you have with them?
I mean, I think there's lots of different, misconceptions. And I think the key for all founders is to really get somebody on your team or on your side that can help give you advice and give you insight on how to work through the process. So I don't know if there's one thing that sticks out. I mean, there's certainly lots of mistakes we see founders make throughout the process, but I'm not sure there's necessarily a misconception. I think there are a number of founders or many founders who really understand the process and give good advice, and they still make mistakes sometimes in terms of you know what they put on their deck, or the financial model like being unrealistic. And there are certainly lots of self-inflicted sort of mistakes, but I think most founders actually understand the VC process pretty well. And there's so much material online, there's really no excuse to not understand. There's so many things that folks could read, and guides and advice, and books. And so um you know that's definitely a lot better today than it was 10 or 15 years ago.
That's very true. There are a lot of great resources out there. It comes to mistakes that founders make. I mean, we talked about some of the mistakes that folks can trip over the pitch deck and in those early meetings. What are some of the mistakes that you see causing snags in the investment process as you get a little bit deeper into diligence and are closing in on a term sheet?
I would say it's not being ready with extra materials or anticipating questions. So, often it is like we'll ask for a financial model, and the founder will say, "Well, we need another week or two to finalize it." Well, you really want to be ready when you start going out, because if you're lucky to get a first meeting and a second meeting and things are moving, the last thing you want to do is sort of hit the brakes and say, "Listen, I need a few weeks to get ready." So I would say really make sure all the materials, the data room. Again, if you have a good advisor, they can tell you all the things you will need, like the market sizing analysis, the competitor analysis. Like, we're going to ask all these questions, or we're going to try to make it up ourselves. So it's better if the founder's prepared to try to answer the most common questions. And that's kind of what we see as snag. Like, we'll ask for something, and we just never can get comfortable with the market size, or we never get comfortable with like a financial plan, and we don't believe the founder has any idea where they're going to be a year or two from now, or how they're going to get there, how many people they have to hire. Like, we want to see a basic understanding of how they're going to run the business. What are they going to do with the money once we, invest? So I think it's really important to be ready before you go have the first investor meeting. You really want to have all the documents kind of in line, so that you can get all the way through the term sheet and then, into diligence, and not start making things as you go, because that's going to make for a lot of very long nights and a lot of delays, and delays ultimately kill investment opportunities, because we start losing faith in the founders. And that's the most important part of the process.
Yeah, absolutely. If if a founder says they need 1 to 2 weeks to build a financial model, when you ask them for that during diligence, it probably means that they don't have one, and they're like scrambling on the back end to whip something together, which is not a good sign, as far as like building confidence goes with that investment opportunity. So yeah, it's something that we try to stress with our founders, is like having everything ready to go in a data room before you hit the ground running with that pitch meeting sprint. Covered a lot in the last 45 minutes or so. And I think we hit on the majority of the questions that I was looking to talk through. Love to hear if you have any other advice or insights that you want to make sure you get out to our founder community, or any other resources that you would point founders towards if they're looking to get smarter as they prep for their fundraises. Yeah, would love to give you the opportunity to share any of those.
The in parting, I think what I would say is it's really important to like the personal interaction. So go to events and talk to people, right? Get advice from people in the industry. But also remember that it's a people sort of interaction, right? So we invest in people, and we're people, right? And so often I think I go to events, and it's 8:30 or 9 o'clock at night. I just, did a 1 hour panel, and people try to pitch me like right then and there. And I say, "Listen, I'm really tired. Send me a deck." And people just keep pitching. And that's like, it's a person interaction. It's important to read that. It's important to show empathy. It's important to show the understanding, the interpersonal. It's just like selling customers, right? You can't go to an event and after dinner, when everyone's having a good time, try to like close a deal, right? Customers aren't going to buy. And so I think that's the relationship is an important piece. And so building that relationship over time, maybe asking for advice, even if you're not raising capital, showing that you can follow up. Obviously with, email today, we all have infinite memory. Like, today someone just asked me if I had looked at a deal and I went to my email and I found the deck from 5 years ago. And this company had made very little progress in 5 years, right? So remember that anything you send out, you gotta hit what you say you're going to do, because that's our biggest point of evaluation. And so if I meet someone at an event and they tell me that they're going to be at $1 million by the end of the year, I usually ask them to send me something after the meeting, and then I remember, right? Because I can check my email. And then if you hit the million, that's a really strong selling point for us to consider an investment. But if you get to 250,000 at the end of the year, you were far off, right? And so those things are really important. But I think it's important to remember this is a relationship from the first time we meet, and then potentially for 5 or 7 or 10 years after we make an investment. And so it's really important to also have a good fit. Like, make sure, you click with your investors, you have the right, you aligned on your expectations and where you want to take the business, on the growth aspect, on the risk tolerance. Like, there's a lot of things that need to really mesh to make that relationship fruitful and hopefully work.
Yeah, absolutely. I mean, I think the more individual data points that a VC is able to string together on a particular founder, the easier it is to get conviction around that opportunity, assuming that they are able to back up the things that they say they're going to do and follow through on those. We always hear that investors invest in lines, not dots, and so the more dots you can put on the chart to be able to plot that growth trajectory, the easier it makes it on the founder once they are actually going out through their pitch process and making that ask for the investment. I think that's a really good piece of advice to leave founders with as they're gearing up. Even if, like you said, even if they're not actively raising capital, to just be out there building relationships with VCs, sharing materials, and allowing them to follow along, so that when you are going out to raise capital, that they already have a little bit of a narrative forming in their head around what the company is and what their potential is as a business.
Yep, that sounds exactly right.
Well, I think that's a really great place to leave us then. Mark, thank you very much for taking the time to chat with me today. I really enjoyed this conversation. This will be a great addition to the tapestry that we're forming around how investors evaluate startups and what founders can do to maximize their chances of success. Really appreciative of Air CFO and Las Olas' partnership. I'm glad that we were able to meet at that topless restaurant in New York a few months ago. And yeah, wish you all the best. Looking forward to continuing to follow along with the Las Olas journey.
Yeah, thanks, Alex. Thanks for having me today.